Hello. Thank you, everybody, for joining the webinar today. We're going to give it another minute or so just to let a few additional participants join in here. But just to let everybody know, there is a chat on the right side there. If anybody has any questions, I know I've gotten some email questions that I'll go through. There's also in the handouts, there's actually a PDF of the presentation that we're going to walk through today. So if anybody wants to review those separately, you're welcome to. After the webinar too, you'll get an email of the recording of the webinar. So yeah, that way, if you want to replay it, you're more than welcome to. We're kicking off this series and we're going to be doing it through the rest of the year. So it's a great intro course for a lot of people who are just trying to learn a little bit more about cash balance plans, what they are, and how they work. So we'll just kick things off here in just a few seconds, okay? Okay, let's kick things off. So I'm Paul Sundin. I am president of Empyrean. Today we're kicking off our series on cash balance plans, what they are, how they work. This is more of an intro course, kind of walking people through basic plan structures, giving them an idea of what we do. We're planning on doing a little bit more, some more sophisticated webinars in the future, talking about investments and a variety of other things as well. So let's just dive into it. I'm planning on this to be about a half hour. We've got extra time for questions. I've got a few questions that were emailed over to me. But if it takes 45 minutes or whatnot, and again, there's going to be a recording afterwards in case you have to leave early. So let's get started here. First of all, I'll give everybody an overview on what we're going to be doing. We're going to talk a little bit about, briefly about myself and Empyrean. Then we're going to talk a little bit about what a cash balance plan is, talk about some of the differences, between defined benefit plans and 401ks, other types of defined contribution structures. Also, we'll take a look at the pros and cons. Whenever we're discussing these plans with someone, pros and cons is very imperative to us. We really try to make sure people understand probably less the pros, more the cons, because I think if you can deal with the downside, I think the upside takes care of itself. We'll talk a little bit about good candidates for the plans. We'll also talk about some of the strategies and things that we do. Then we'll have some Q&A. Lastly, you're welcome to reach out to me. You're welcome to set up a call, to look at your situation. You can sign up for an illustration if you want as well. We'll talk a little bit about how to do that at the very end. So first of all, a little bit about myself. I am a CPA, been a CPA for 30 some odd years, focused a lot on business tax planning, retirement structuring, started doing these plans about 10 to 15 years or so ago with many of my clients, and been involved with probably over 1,000 plans over the years, and structuring them and so forth. Really what we do is we try to set up plans and, try to be efficient from the tax side and, review entity structures and things like that with the plans as we walk through them. Now, Empyrean, we do the structuring of cash balance plans and defined benefit plans. We're what we would call a third-party administrator, which means that we handle essentially the compliance. We are not investment advisors, so we can't tell you how to manage the investments. We also don't do tax returns. But we spend a lot of time talking to CPAs, educating them on these plans and how they work and so forth. Our goals at Empyrean are really to educate clients on different types of structures that many CPAs and financial advisors don't necessarily get involved with. But our ultimate goal is to lower your tax bill and ensure that your retirement accounts grow with effective utilization of these plans. So jumping right into it, what is a cash balance plan? We'll talk here on the next slide where we talk about the difference between cash balance plans, defined benefit plans and defined contribution plans. But what is a cash balance plan? A cash balance plan is a type of defined benefit plan. It is the most used typically today for small business owners. It most used defined benefit plan structure that is used. And I really use that interchangeably. Sometimes people come to us and they say, hey, I want a cash balance plan, or I want a defined benefit plan. Again, most of what we do and most of our competitors will set up cash balance plans. And again, since they're a type of defined benefit plan, we use those words interchangeably. But it is a type of approved qualified plan, which is a qualified plan by the IRS that allows for full tax deferral, very similar to a 401k or a SEP that most people are familiar with. It is, like I said, a type of defined benefit plan. It specifies a specific benefit at retirement. It is calculated annually by our actuary, has to be reviewed annually, get funding levels, as well as filings completed annually. And typical contributions are over $100,000. I mean, these plans are great for people who have exhausted 401k plans and who are looking to get a little bit more into retirement than the basic plan structure. So let's talk a little bit about the difference between defined benefit plan and defined contribution plan. Most of our clients that come to us already have a defined contribution plan, sort of like a SEP or typically a 401k plan. Those are types of defined contribution plans. So really what those are is the limits are established by the IRS up front, okay? Once you meet that requirement up front and you make that maximum contribution, it doesn't matter whether the assets in the plan go up or down because the limits are established up front. Whereas a defined benefit plan works a little bit in reverse. We can get in up to $3 million, actually $3.1 million at retirement age of 62 or 65, typically 62. And so because we have that very large amount that we can get into the plan, we can make very large contributions as we get closer to retirement age. So, again, whereas you might have a 401k where most people will put, 20,000 up to, 67,000 in a given year, a defined benefit plan, depending on age and compensation, you could get substantially higher amounts. We'll roll through a couple examples that we've got here, but certainly contributions, upwards of $500,000 are doable depending on the situation. Okay. But be careful. A lot of times people come to us after they fully funded a 401k or a SEP. There are specific rules when you combine these plans. Okay. So, you want to be very careful if you've already got a defined contribution plan, a 401k. I would definitely not make any contributions, any additional contributions, any plans that you have for the given tax year until you decide exactly, what structure you want, because there are rules that limit these plans when you combine them together. Why do people set up the plans? Number one reasons for tax deferral. Again, every dollar you put in will reduce federal and typically state income taxes. Most of our clients are at a 40% tax bracket, so every dollar saves you 40 cents. Large contributions up to 300,000. I just said you can get in up to $500,000, really depending on your situation. 300,000 might be a standard base, a high-end base contribution in that neighborhood, but you could do prior service and a few other tricks to get those contributions a little bit higher. Another reason, great for people to put to catch up on retirement. We find a lot of business owners that, they're in their 50s, kids are out of school, the mortgage is paid off, it's time to really crank on retirement. That could be a great option for them. You also can contribute up to the date that you can file the tax return. In fact, you can set up a plan and contribute up to the date you file for the prior year. So a lot of times people are doing these. We just got done with the 2021 tax season where people could open these plans up. So still a great opportunity for people who, are a little late to the game. They're also not just for large businesses. Traditionally defined benefit plans are, were more sophisticated pensions used by large companies, but more and more we're seeing small companies, sole escort plans, 2 to 5 or 10 member, businesses or employees to be able to get money into the plan. So definitely small businesses can participate. Let's chat a little bit about the pros and cons. The pros, we've talked a lot about some of the basics, but you can certainly get much higher contribution amounts in. You can also combine them with a 401k. Generally, you cannot with a SEP. You can in some situations, but generally speaking, be careful with a SEP because they don't combine with about half of the SEP models out there. If you've already funded a SEP or if you've got some concerns, you could certainly reach out to us and we can discuss. When they are combined with a 401k plan, the profit sharing is limited to 6% rather than the traditional 25%. So, that can limit it a little bit. They also can be rolled over into an IRA or 401k. That is typically the exit strategy. These are great plans to have when you have high income and you want to make some large contributions. But once you get to a point where maybe your business is winding down, maybe you're going to sell your company or something, and you're going to terminate your plan, you can typically terminate and roll it over into an IRA or 401k. So it makes it very simple and easy. At the end of the day, you'll follow the IRS rules for the IRAs once you get to that point. Also, you do have flexible funding with these plans. I think there's a little bit of a misnomer out there where people think, you're locked into maybe $100,000 a year contribution or whatnot. That's not necessarily the case. You typically get a range. Very often that range is very flexible. It could be a range of minimum of 100,000, maximum of 300,000, depending on how we structure the plans. So, you want to take advantage of that flexible range, and you're not necessarily locked into anything particularly. But you will have to fund the plan. We'll talk a little bit about the cons. These plans, the negatives, they're more expensive to maintain. We set up a solo plan for $990. We'll do $250 for a participant fee. They're going to cost you about $2,000 a year, $2,100 a year to administer. If you've got 5 or 10 employees, it could be a few $1,000s a year. So they're definitely more expensive than a traditional 401k plan. So again, if you want to just get, 10, 20, 30 grand in, stick with the 401k. All right. But this plan is going to make a little bit more sense when you want to get more in. They're also permanent in nature, and they are, the general view is that you can set up the plans and have them open for at least several years. At least that's what the IRS has said. They don't designate necessarily what several years means, but I would say at least a few years. You want to have long-term intent. This isn't a situation where you fund the plan for 1 year and then you terminate it. It has to be an ongoing plan that you're looking to contribute. Obviously, if something happens where your business changes, we saw a lot of this during COVID and other situations where your business is going to sell or your business is winding down or COVID or some other issues, you certainly can terminate plans. But generally look at them as something with long-term intent. They're definitely more complex to explain to clients as well as to employees, and more complex to administer. These are really dialed into your age, your contribution levels, and again, funding ranges. So again, they're a lot more complex to understand. That's what we're here for. And not only do we do the compliance, but we really consult on the plans operationally and try and help you, get the funding levels you're looking for. Lastly, of course, there's mandatory contributions. This kind of ties into the permanency of the plan. So, assume that you're going to have to make a mandatory contribution every year. Not always the case, depending on prior funding or investment returns, but, definitely something, you want to think of as mandatory contributions. Again, you can send questions in, in the chat box. If you've got a couple, I've actually received a couple here. Feel free to send them over, and also take a look at the handout if that helps you out a little bit more too. So moving on, who are the best candidates? Companies with consistent profits. I'll go to number 2 as well. Professional services businesses. Typically, professional services businesses, physicians, lawyers, CPAs, architects, actuaries, other types of folks. They'll generally have higher consistent income, which makes them very good candidates for these types of plans. we do a lot of plans with other people like real estate agents and so forth, but I think a lot of people are aware of what's going on in the market right now. So not unusual to see a real estate agent maybe making $1 million one year and then making nothing the next year, very nominal amounts. So you want to be careful in situations like that when structuring a plan. But again, good candidate is someone with high consistent income. Also someone looking to catch up on retirement savings. Someone who's maybe a little bit behind, someone who's also in a high tax bracket. We might see situations where someone has a business that isn't, might make a couple $100,000 a year, which is typically on the low end for these plans, but maybe their spouse makes $500,000, $600,000, $800,000 a year. Maybe they live in California or Manhattan, where they have very high tax rates. And, as a result, they're really looking to maximize those tax deductions. Also, they can be very good for companies who are looking to improve morale and employee retention. We have a lot of companies that like to use these plans sort of like a bonus structure, where they can provide a little bonus or incentive to their employees. Can work very well in those situations to also, give the owner a nice contribution as well. We're going to talk right here about 3 specific funding examples. I've laid them out in this table here, and we're just going to use some hypothetical numbers to talk a little bit about some of these options. We've chatted briefly about the fact that these plans are age-driven and income-driven. Again, the older you are and the higher your compensation, generally speaking, the more you can put into these plans. Okay, so I've got 3 separate situations here that we'll go through, and all 3 of these would assume an S-corp structure. With an S-corp, we're looking not for the profits of the S-corporation, we're looking for the actual compensation of the owner. So in our first example, we've got a 35-year-old IT consultant making $200,000 a year with a business profit of $150,000. So this consultant has $350,000 of income. They can do the 401k deferral of $20,500. That is on an individual level. They can also do a profit sharing. Remember, the profit sharing is capped at 6% of the W-2 compensation of the $200,000. So that's the $12,000. In this situation, the owner has a first-year contribution of $98,450. Again, we can structure this to get a little more in, a little less in, depending on the owner's goals. We can often front-load plans. In this situation, that was a good fit for this owner. In fact, if you look at the $130,000, that pretty darn close comes to wiping out a lot of that business profit there. Tax savings at 40% is $52,000. Okay. Second example, 58-year-old physician. So here you go. You got someone a little bit older, a little bit more income, although W-2 profit's the same. So we've got a W-2 of $200, business profit of $400, total income of $600. Now the deferral for someone over 50 is $27,000 on the 401k. Profit sharing would still be 6%, so that's going to be the exact same number as the 35-year-old consultant, the $12,000. Also, then the contribution for this person, because of age, again, we've got the W-2 is the same, but based on age, this person's getting $212,000 in first year. Again, total contribution of around $250,000, saving about 40% in taxes, or about $100,000 there. So not unusual for tax savings to go a lot higher than that. I'd say probably about a third of our clients are in California. And so as a result, we see tax rates well over 50% for some of our clients. So certainly something that you could chat about with your CPA to see if what your tax savings is going to be. Last example, 65-year-old attorney, W-2 of 305, which is the maximum that we can use. And in this scenario with the $200,000 profit, we often get attorneys that might be involved in certain types of litigation settlements where they might make $200,000, $300,000, $400,000. All of a sudden they get a year where they make $2 million. So therefore we do what we call front load a plan or get in prior service. As you can see here, walking through the contributions, again, this attorney is over 50, gets $27,000 in, gets 6% of the profit sharing. That's on the W-2 of $305,000. That's the $18,000. and is able to get $502,000 in for the first year contribution. In this scenario, we were able to pull in some prior contribution amounts or prior compensation to be able to get that a little bit higher. So almost got that one approaching $550,000 with almost $220,000 of tax savings there. So again, a few different examples starting at kind of low end of the range all the way up so you can get an idea of how these plans are structured. A few strategies that we use to get these plans a little bit higher and lower. We can include a spouse in a plan. If you've got a spouse that works for a business, we also would want you to consider paying yourself a higher wage. You're required by law to pay yourself a reasonable wage for the work that you do. That wage is subject to employment taxes. And so, you have some flexibility to get that number higher or lower. We can exclude 60% of employees. Kind of ties into number 4. We have to provide a meaningful benefit. So, we can get by giving a much smaller amount to, business owners, to employees of business owners. Also have the flexibility to combine with the 401k and profit sharing. So we use that strategy if someone doesn't already have that in place. Also, companies can hire part-time employees or people under the age of 21. They are not eligible for the plan, so that helps us to get a little bit more in. Some of our clients have contract employees that can help, or they use a lot of contractors. Also, we can use 3-year vesting to limit the amounts that can be vested with some of the employees. We also do plans that we structure to get more in, where we consider life insurance, where we also do analysis on QBID on Section 199 for number 10 there. And we can also determine if overfunding is an option. Again, it does make a lot of sense if you had a really good year to overfund a plan. If you maybe were an attorney and got a high settlement, or you're a real estate agent where you had a really good year and you're expecting more lean years in the future, you definitely can, with different ways that we can structure those to get an upfront amount. Bottom line is, you come to us with your situation, what you're looking to accomplish. Our goal is to try to structure this plan to make sure it's most beneficial for you and your situation, okay? Each plan that we do is customized and tailored specifically for you. Couple things on the setup deadline and contribution deadline. These plans can technically be set up and contributed to before you file your tax return for the prior year, so you have some time. But most of our clients, and we definitely advise people to get your plans set up by the end of the year. Our busy time, of course, is November, December, because you got to make sure you've got your 401k in place and operational. You don't want to overfund the 401k, which we find a lot of. And you want to make sure your W-2 for your S Corp or C Corp is established very well, or is established at the end of the year. That's when you need to make sure your payroll is finalized. So deadlines are going to be critical. Most people are looking to get a plan set up here in the next couple months for 2022. What we do at Parian, we offer a turnkey solution. We do free plan consultations. We do a strategy review. We review all your IRS filings, complete them all, Department of Labor forms, 5500s. We do all the actuarial review, Schedule SB. We effectively, our actuary effectively signs off on your contributions. So we pretty much do everything for you turnkey. I'll just go back to this. We'll talk a little bit about pricing. I think we talked a little bit about it, but again, our fees are all inclusive. There's no additional actuary fee. These plans are going to cost you a couple $1,000s a year to administer. So definitely do not make a lot of sense for people if you're looking to just get 20, 30, 40 grand in a year. But if you're looking for, high contributions, 75, 100, our average client's about 150 grand a year. If you're looking for those high contributions, I think the fees are well worth it. Obviously, our fees in addition are tax deductible as well. Lastly, a way that you can get in touch with me for more questions. At the end of the webinar, you'll be taken to our contact page. There's actually, if you go to our main website, you can go to our contact us page or contact form. Through that form, you can reach out to us and have an illustration done. You can also sign up for a free call. We do free half-hour consultation calls where we really see if a plan makes a lot of sense for us. You're welcome to dial the number or email me any questions you've got directly. Always glad, to take any questions here. And, that's it. That's just the goal is just to give you a general overview on the plans, how they're structured, point out some pros and cons. Feel free to get back in touch with us if you've got any questions. I did get a couple questions that came through that I'm going to answer here. Looks like we're at about the 25-minute mark, so I think we're in pretty good shape. First question I've got is, can a sole proprietor open a plan? Absolutely. At the very beginning, I mentioned that these plans allow you to get, they're not just for large business owners. You can use sole proprietors. So you can do an S Corp, C Corp, or even someone who's a Schedule C, what we would call a disregarded entity or sole proprietor. The calculations are a little bit more complex, but absolutely can do it. You don't have to have employees. You don't have to be on payroll necessarily if you're a sole proprietor. We can walk you through those and give you an idea how that works. Another question that came in, how does prior compensation help to increase funding? Well, there's a variety of tricks that we can use, but sometimes if someone has a low W-2 in a current year, I'm just going to make up numbers here, but let's say they're 50 years old and they want to get 200,000 in, but maybe they've only paid themselves 50 grand. Of course, there's some time to get your W-2 updated. If we have a situation like that, where there's someone who's trying to get that additional compensation in, sometimes what we'll do is we'll look to compensation in the past. So even if they got 50 grand this year, we can look and we can see maybe they had 100 grand last year, 200 grand the prior year, and make sure that we can justify, that large $200,000 contribution. In addition to that, there are, generally speaking, sort of individual limits. I'm just going to use some rough numbers, but let's say for a 50-year-old, the limit might be 200,000. If someone really wants to fund, we can typically get a deductible amount that'd be about 150% of that. So if it's possible that this 50-year-old person hypothetically could get 300,000 into the plan. In order to do that, we need to give them an opening credit of an additional $100,000 for prior service. So again, usually in most situations, we're using prior compensation because someone's had a really good year and wants to get a lot of money in. Sometimes it's because they have a low W-2 this year or whatnot. There's time to correct that. But generally, that's it. We kind of try to look to what the client wants to do, and then we can look at their compensation history to determine if we need to bring that in. Sometimes there's problems with prior compensation because you might have had employees on the payroll, and if we bring in, additional employees from the past, that can make it open the plan to other prior employees. But for a solo plan, usually not a problem. Another question I've got: how long does it take to set up a plan? Good question. Generally speaking, takes us about a week. We have an online sign-up form. Once you sign up and submit it to us, takes us about a week. We get the documents over to you to electronically sign to get the plan set up. The important part of our process, though, is the onboarding call. Once everything's signed, we set up a call with you where we can help you get your account opened at Schwab, Fidelity, Vanguard. We don't open the account for you, but we've got a bunch of tips and tricks. We've even got a rep over at Schwab and a couple other folks that we can get you with to help you get your account set up, because that seems to be kind of a stumbling block for a lot of people. Last one, someone says here, what can I invest in? Most people will just do basic stocks, bonds, mutual funds, but you really can self-direct these plans. You can do real estate, you can do a variety of investments, but you need to be careful because those are any self-directed plan. There's additional rules and requirements. Feel free to reach out to us. We can discuss how those work. That can make your funding a little bit trickier. I always tell clients, this is probably the plan that you do not want to self-direct. You certainly can, but self-direct your 401ks and your IRAs. It's usually a little bit easier to do, and there's less compliance headaches. So if you want to self-direct that usually makes a lot more sense. But again, most people will do stocks, bonds. A good point to note is that if everybody's a lot of people on this webinar might be aware of the fact that the market is a little volatile right now and interest rates have gone up a lot. These plans have a 5% built-in rate of return, generally around that. So you want a conservative rate of return for the plans. And right now you can get 1-year CDs, certificates of deposit, for 4%. So very easy right now in the current environment to mitigate the risk. You could do 80% into a CD, maybe 20% stocks, bonds. That way you're not going to get in a lot of trouble. If people have invested, too heavily in stocks, bonds, there can be some other, some other complexities there, because again, you want to just kind of get a general return of 5%. In a perfect world. That's it. Let's see, any other questions? I think we're right just past the 30-minute mark. What if returns are less than 5%? Is one that just came in. Our actuary assumes 5%. Now, we know that plans aren't going to return exactly 5%. You might make 2% or 10% or whatnot. Usually somewhere between 0 and 10 is not that big of a deal. But I would tell you that generally speaking, if your returns are less than 5%, that might mean that your future contributions are going to need to increase, right? Because we've got this fixed defined amount. If you're earning less than what we are thinking you're going to earn, you have to make a higher contribution. Likewise, if your returns are higher than 5%, it'll tend to push your contributions down. That's why the number one reason that people do these plans is for tax purposes. So if someone has a home run stock or they made 20 to 30% returns on a stock, you don't really want those in this plan. You want those in a 401k or IRA, because those really high contributions will push your contribution levels down, which of course are not great if you're looking for tax deductions, okay? So that can make it a little bit more challenging. But good question. We get answered that a lot. We also have that on our YouTube video. If anybody is interested, you can go to Imperium YouTube channel and see a good video we've got there on the rates of returns for investments and things of that nature. So very good. We're about the 32-minute mark. Looks like that's going to be about it for today. I hope everybody enjoyed this. Again, you will get a replay of this sent out to you soon after this is over. And feel free to reach out, email me, reach out to us if you want to set up a call, or you want to set up a plan, or at least run an illustration or see if it makes sense for you. Again, these plans are complex, and I don't expect you to understand everything from this video, but hopefully this is a good option for you guys to be able to take a look and get a basic understanding. Thanks again to everyone for joining today. Bye-bye.